Dear traders, Brent crude oil technical analysis today reveals a battlefield where the daily trend remains a firm sell, yet the 4-hour and 1-hour charts are screaming buy. This compression zone is why support at 92.19 and resistance at 97.79 are the only two numbers that matter for your next trade. In this session we map the exact sniper entry off the resistance rejection, the active trader's dip buying play into the demand zone, and a high-risk aggressor short that capitalizes on the headline euphoria, complete with stop losses, targets, and invalidation levels. Whether you're looking for the next crude oil breakout prediction or want to know why oil is rising today despite a daily sell signal, this breakdown arms you with 3 precise trade plans. Brent oil just ripped to a 1-week high, straight into a price level that has liquidated breakout chases every single time over the last month. Right now, at 95.93, the market is whispering one thing and screaming another. There is one danger zone and one hidden opportunity in this oil chart, and I'm going to show you both. Stay to the end. I'm giving you 3 exact levels you can trade tomorrow, with precise entries, stops, and the risk-reward ratios that separate professionals from gamblers. Write this number down. 97.79. Write it large. If Brent takes out 97.79 on a 4-hour close, the entire daily sell structure we have been writing resets. I don't care about the headlines, I don't care about the Iran proposal. Above 97.79 the daily trend flips, and we pivot. Until then, my session bias is fading this spike. I am looking to sell into strength inside a range defined by 92.19 support and 97.79 resistance. This is not a trending environment, this is a trap zone. The macro order flow tells you exactly why. Right now, retail traders are chasing the Iran review headline, piling into calls at the 100 strike, certain that a ceasefire means $105 crude. Meanwhile, the big institutional desks, the guys who warehouse risk, are using this spike as an opportunity to distribute long inventory into strength. That divergence is the trap. The herd is leaning long right at the top of a daily downtrend channel, and that positioning makes a failure at 97.79 incredibly violent. So I'll say it again. The single invalidation level that flips everything is a 4-hour close above 97.79. Until that happens, I am structurally bearish below that number, and every rally is suspect. Let's walk the charts from the monthly canvas down to the 60-minute heartbeat, because the technical stack here is a masterclass in conflict. On the monthly, the trend is a strong buy. Crude has been stair-stepping higher on supply constraint fears for months, and the 200-month moving average sits way down at a level that doesn't even factor into this conversation. We are structurally elevated. But zoom in to the weekly, and the picture immediately clouds. The weekly trend is dead neutral. Price is coiling between the 20-week MA, which I track at roughly the 98.12 zone, and the rising trendline support near 89.40. That weekly neutrality is the canvas on which the daily sell signal is painted. The daily chart is flashing a sell, and it is not a weak sell. Look at the daily moving averages I have on screen. The 5-day MA is 95.32. The 10-day is 97.01. The 20-day MA is sloping down at 99.14, and the 50-day MA is flatlining at 98.12. Price is currently trapped below the 10, the 20, and the 50. That is the textbook definition of a bearish alignment on the daily. The RSI is at 44, not oversold, just weak. The MACD is deeply negative at -2.71, and while the histogram is beginning to curl, the signal line has not even thought about a bullish cross. This is a daily downtrend that is taking a breath, not ending. Now here is where most traders miss the entire plot. Drop to the 4-hour chart, and the trend flips to buy. On the same asset, at the same moment, the 4-hour structure is printing higher lows and is now pushing into the 54-hour MA. The 1-hour chart is even more aggressive. It's a strong buy. The 60-minute momentum is vertical off the 92.19 support test 2 days ago, and the 5-hour MA at 95.32 is now acting as dynamic support, pushing price higher. This is the compression. You have a daily time frame that says sell rallies, and an intraday timeframe that says buy dips. That is exactly where the algorithm hunts, and exactly where uneducated money gets trapped on the wrong side. When every retail trader sees the 1 hour screaming higher, they hit the buy button, and the daily engine flushes them out. My job is to show you the trap before it snaps shut. Look at the moving average structure on the daily again. The 100-day MA at 91.81 is the real floor. That's the line that held the last two sell-offs, and it lives right above the 92.19 support zone. The 200-day MA is far below at 83.26, and we are not going there unless we see a demand shock. So the support ladder is clear. 92.19 is the immediate demand zone, backed by 89.40 if we lose it. Resistance is equally clean. 97.79 is the first brick wall, followed by the 50-day MA at 98.12 and the 20-day MA at 99.14. Those two moving averages create a resistance cluster between 98.10 and 99.20 that will be incredibly difficult to crack without a fundamental catalyst that changes the daily trend structure. Above that, 100.58 is the psychological magnet and the real breakout level. Here's what most traders miss. The hidden divergence on the 4-hour chart is the silent assassin. While price has been grinding higher from 92.19 toward 96, the 4-hour RSI has been making higher lows as well. That looks like confirmed momentum. But overlay the MACD. The MACD on the 4-hour is still negative, and the histogram is rising into a potential bearish divergence if price tags 97.79 without the MACD crossing into positive territory. We are not there yet, but that setup is brewing. This is the next signal that changes everything. If Brent tags 97.79 and the 4-hour MACD fails to follow through with a bullish cross, that will be one of the cleanest momentum failure signals I have seen in oil this quarter. The trap will be fully loaded. The daily downtrend will have drawn in every breakout buyer, and the rejection will be merciless. Now we have to talk about the geopolitical heartbeat, because oil right now cannot trade on supply and demand fundamentals alone. The 24-hour headline that matters is this: Iran is reviewing a U.S. proposal to halt the war. That single sentence injected a Hormuz premium into every barrel of crude. But here's the brutal truth that institutional desks understand and retail does not. A ceasefire announcement removes that premium. It does not add to it. The fear of supply disruption through the Strait of Hormuz is what has kept a floor under oil. If the war narrative de-escalates, the geopolitical bid exits the market in a matter of minutes, and crude can freefall $3 to $5 before anyone can adjust their screens. Yesterday's price spike was not a demand upgrade or a supply cut. It was a headline squeeze that forced short covering into a resistance zone. That is the worst possible place to establish new longs. Cross-asset linkages confirm the caution. Brent is moving almost tick for tick with the US dollar's intraday swings, because a strong dollar is a headwind for commodities, and the DXY is hovering near 105 with a stubborn bid. At the same time, S&P 500 futures are struggling with breadth deterioration, and Bitcoin is stalling, suggesting the risk asset complex is not confirming a sustained commodity breakout. If equities roll over, oil will not be immune, no matter what Iran says. My 1 to 2 week directional lean is this: I expect Brent to reject 97.79 and rotate back toward 92.19, carving out a broad range between 89.40 and 100.58. The event that invalidates that lean and forces me to turn structurally bullish is a daily close above 100.58. Below that, I sell rallies. Now I want to read your pulse. Do you think Brent breaks 97.79 this week? Comment break or reject right now. I am tracking consensus, and I will share the aggregated sentiment in tomorrow's session. Most people skip this next section. That's exactly where the money is made. Keep watching. I am about to hand you 3 trade plans with exact entries, exact stops, and risk-reward ratios you can screenshot and trade immediately. Strategy 1 is the sniper, the conservative play designed for the patient trader who wants to sell into exhaustion. The idea is to short into the 97.79 resistance zone with confirmation. You do not blindly place a limit order. You wait for price to enter the 97.65 to 97.79 band, and you need a 1-hour bearish engulfing candle or a clear long wick rejection that closes below 97.50. That is your trigger. The stop loss goes at 98.15, just above the daily 50 MA and the recent spike high. The logic is straightforward. If price has the strength to push through 98. 15. The rejection thesis is broken. Your first target is 95.32, the 5-day MA, where you bank 1/3 of the position and move your stop to entry. Your second target is 92.50, just above the major support cluster at 92.19. The risk-reward on this setup is exceptional. You are risking 45 ticks to gain 235 ticks to target 1, and over 500 ticks to target 2. That's a risk-reward of more than 1 to 5 on the first target, and 1 to 11 if the full move materializes. Void the entire sniper setup if the daily candle closes above 97.79. If that happens, you step aside. The structure has shifted. I've put the exact sniper trade card on your screen right now. Study it, screenshot it, internalize every level. The sniper, conservative, entry, 97.65 to 97.79 on 1H bearish engulfing close below 97.50 stop loss, 98.15 take profit 1, 95.32 take profit 2, 92.50 risk, reward, 1:5.2R to TP1, 1:11.5R to TP2 invalidation. Void if daily close above 97.79. The second strategy is the active trader, the standard play that exploits the herd's confusion. While the crowd is trying to chase the breakout, the smarter money waits for the mean reversion. If the sniper scenario plays out and Brent rejects 97.79 and tumbles, do not chase the short at that point. You wait for the dip to exhaust itself right into the demand zone. The active trader's long entry is a buy limit between 93.50 and 92.50, with confirmation of a 4-hour bullish hammer or Morningstar pattern. This zone aligns with the 100-day MA at 91.81 and the established support at 92.19. Your stop loss goes at 91.40, below the 91.81 level and below the structural floor, giving the trade room to breathe under the congestion. Target 1 is 95.90, just below the current price and the 5-day MA, which would act as initial resistance on a bounce. Target 2 is 97.50, right into the resistance zone that we are watching now. Once target 1 is hit, move your stop to break even and let the rest run with a trailing stop of 80 ticks. The risk-reward on this active trade along is roughly 1 to 2.3 to target 1, and 1 to 4.5 if target 2 is reached. This trade only works if the rejection from 97.79 happens first. If Brent never gives you the dip and instead rockets through 97.79, you skip the long and flip to the breakout play that I'll cover in tomorrow's wildcard. Your on-screen trade card for the active trader is now up. Lock these numbers into your platform before the session gets volatile. The active trader, standard, entry, 93.50 to 92.50 on 4H bullish reversal candle stop loss, 91.40 take profit 1, 95.90 take profit 2, 97.50 trailing stop after TP1, 80 ticks invalidation. Void if Brent never reaches entry zone before breaking above 97.79. Type your Brent oil range for tomorrow in the comments now. Give me your high and your low. I want to see who is aligned with the compression. Drop it in the comments. This is how we build an institutional-grade community. Strategy 3 is the aggressor, and I have to give you a clear warning up front. This is a high-risk, counter-trend momentum chase designed only for those who can lose small and manage risk with zero emotion. The aggressor short entry is here and now, at 95.93, if and only if you see a 15-minute bearish divergence forming on the RSI with a lower high in price. The entry trigger is a 15-minute close below 95.70 after a momentum spike, with volume confirming the fade. The stop loss is tight at 96.45. Above the intraday liquidity sweep. Target 1 is 94.20, and target 2 is 93.00, just above the active trader's long zone. The risk-reward on this aggressor trade is roughly 1 to 2.3 to target 1, but you are fighting the 1 hour strong buy trend, so you must be willing to take a string of small losses. If you do not have a strict 1% risk model, do not take this trade. The invalidation is a 15-minute close above 96.50, at which point you exit immediately, no questions asked. Only the most disciplined traders should even load this plan onto their screens. And here is the aggressor trade card on screen. The levels are tiny, the speed is high, and the risk is real to the aggressor. High risk, entry. 95.93 on 15M close below 95.70 with RSI divergent stop loss. 96.45 take profit 1. 94.20 take profit 2. 93.00 risk and reward. 1:2.3R to TP1 invalidation. Exit entire position if 15M close above 96.50 before I let you go. The risk management pulse. Never risk more than 1 to 2% of your account on any single trade. No positions through high-impact news events, especially crude oil inventories or OPEC whispers. Stops are non-negotiable. You will be wrong many times. Your only job is to survive so you can trade the next big move. If you violate this rule, the market will take your tuition money, and it will not be gentle. For the next session, the single most critical level on Brent crude is 97.79. That number is the pivot of the entire weekly structure. Above it, the daily sell signal is in serious trouble, and we shift to a bull trend continuation. Below it, the trap is set, and the path to 92.19 is wide open. Tomorrow's wildcard is the weekly U.S. crude inventory report combined with any follow-up commentary from the Iran-U.S. negotiations. That combination can generate a $3 range in under 10 minutes, so do not be caught without a plan. If you want the full breakdown on Bitcoin and the S&P divergence, and why that divergence is screaming a liquidity event in risk assets, that video is live now. Tap the end screen, and I will walk you through the exact gamma levels and funding rate reset that could trigger the next equity slide. Smash like if this gave you a clear, tradable plan. Subscribe, hit the bell, and I will see you in the next one. Trade what you see, not what you hope. I'm signing off.